For those contemplating a departure from the Golden State, there's an additional financial consideration that might catch you off guard: the proposed California exit tax. And should this pass, you want to listen up because it has significant implications. The California exit tax is a levy imposed on individuals and businesses who opt to move out of California. It forms a part of a broader California wealth tax strategy aimed at taxing the wealth of state residents. Individuals with annual income exceeding $30 million could find themselves subject to this tax for a duration of up to 10 years post their California departure. This tax encompasses various assets such as property, holdings, stock, and other investments. To make this clearer, let's talk about an example. Let's say John, a resident of California, has been living and working in the state for the past 15 years. During this time, he has accumulated a significant amount of wealth through various investments, real estate holdings, and business ventures. However, John decides that he wants to move to a different state with a lower cost of living and a better tax environment for his business. Upon deciding to leave California, John learns about the California exit tax, which is imposed on certain residents who choose to leave the state. This tax is primarily targeted at individuals with high net worth or significant unrealized capital gains. Before leaving, John consults with a tax advisor to understand the implications of the California exit tax. California imposes the tax on unrealized capital gains accrued during the time John was a resident of the state. This means that John will have to pay taxes on the appreciated value of his assets, even though he hasn't sold them yet. To calculate the exit tax, John and his tax advisor assess the current market value of all of his assets, including stocks, bonds, a real estate property, and business interests. They then determine the difference between the current value and the original purchase price, or fair market value at the time John became a California resident. After crunching the numbers, they find that John has accrued a substantial unrealized capital gains on his assets. As a result, he will owe a significant amount in exit tax to the state of California. John realizes that California exit tax will eat into a considerable portion of his wealth, but he decides to proceed with his move anyway, considering the long-term benefits of living in a state with a lower tax rate. Upon officially moving out of California, John must file a final return with the state, including payments for the exit tax owed. This ensures that he fulfills his tax obligation before establishing residence elsewhere. In conclusion, the California exit tax could hold a significant implication for high-income earners and businesses contemplating an exit from the state. Its ability to exert financial repercussions for up to a decade following the relocation underscores the importance of grasping its intricacies should this pass. So, thanks for joining. If you have any more questions, please feel free to contact us at Paradigm Accountants. We'll talk to you soon.